Hi everyone, welcome to Charts and Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for TMX Verify. Today we're breaking down the Federal Reserve's second meeting of 2026. Let's dive into the charts and see what the latest FOMC decision means for the markets. First, a quick refresher. The federal funds rate is the overnight rate banks charge each other. While it sounds technical, it's the master switch for the economy. When this rate moves, everything from your mortgage to corporate bond yields to savings accounts to credit cards can feel the ripple effect. The FOMC concluded its second meeting of the year by keeping rates steady in the 3.5 to 3.75% range, keeping it at its lowest level since 2022. The market saw this coming. Expectations were sitting at nearly 100% going into the meeting. So the real story here isn't the decision itself, but the why behind it, found in the press release. The Fed operates on a dual mandate, maximum employment and stable 2% inflation. Right now, they're walking a tightrope. On the jobs front, gains have remained low, and unemployment has been little changed in recent months, showing signs of stabilization at levels last seen in late 2021. On the inflation front, the Fed calls it somewhat elevated, an accurate description according to the latest reports on consumer and producer prices. Not to mention, the implications for the current developments in the Middle East remain unclear for the US economy, with several expecting already elevated inflation to rise even more. So what's next? The committee stated they're prepared to adjust their stance as appropriate if risks emerge that would impede their goals, and they'll continue to take into account a wide range of information, such as readings on labor market conditions, inflation pressures and expectations, and financial and international developments. Given this guidance, how is the market interpreting the Fed's next move? According to the CME FedWatch tool, the market's currently pricing in no rate cuts or hikes for 2026. However, keep in mind these odd shifts in real time with every new data point or development. Now, earlier in the video, we talked about some of the key takeaways from the Fed's press release. But what we didn't discuss, and is perhaps one of the biggest takeaways, was the Fed's dot plot. The committee has grown more unified in the near term, while simultaneously raising its expectation for where rates will eventually settle. Most participants now anticipate the Fed funds rate will hold between 3.25 and 3.75% through the end of the year, showing a much tighter consensus than previous projections. However, this clarity dissolves in later years, with 2027 and 2028 showing a wide divergence of opinions. Notably, the longer run anchor has shifted upward to 3%, signaling a collective belief that the neutral rate is higher than previously estimated. But just like the CME FedWatch tool, these projections are not set in stone and will likely shift over time. The Fed is scheduled to meet again on April 28th and April 29th, and the next dot plot will be released at the following meeting on June 16th and June 17th. That's all for our discussion. Thank you for tuning in. More economic and market insights, you can find my content on the Advisor Perspectives website under the AP Chart section.